This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, it's Joe. Welcome back to the channel. I want to talk about triggers today and entry points. And I want to use sort of the example of, let's say you're watching a stock that has a really good look to it and you're very interested in it, and it has the setup in place, and then when it triggers, it kind of does it on a gap, or you're unavailable when it triggers. And it makes a pretty big move that day, and you feel like you missed it. I want to make sure you understand that that is probably not the case. Although you might have missed that entry point, if you're patient, you're going to get other opportunities in most situations, not every single one. There are times where you'll have a setup, it'll trigger when you're either on vacation or not in or in a meeting or whatever, and it just takes off and it never gives you another chance. But I think that's pretty rare. So the example I'm going to use today is one that triggered using a monthly and a weekly. And so the higher time frame monthly had a really good look to it. The lower time frame weekly triggered. It was about 6 months ago. And since that time, I've seen 3 or 4 additional entry points if you stay on top of the stock, if you keep it in your watch list and you continue to look for triggers. So let me just show you this example. It's First Solar. This is a stock that took a pretty decent amount of time to get going. So in fact, most of the solar stocks had a tough time getting the ball rolling, and now it seems like they've got a pretty good head of steam behind them. But let's just look at this monthly chart. So when you see a stock like this on a monthly, and mostly what I'm referring to here is this breakout like that. I mean, so just to understand, this breakout was taking out the highs from 2014. So that's 1, 2, 3, 4, 5, 6, 7. Let's call it 7 years worth of sideways action, or what I call a sideways line. And it did it with pretty good strength. We got pretty good green DI going, and then we had the pullback. So I wouldn't necessarily buy the breakout in this situation. As I've mentioned, green DI was just crossing over as this was breaking out. So I'd have probably waited for a pullback, and it came into the area of the breakout area and it appeared to be holding. It happened to be a pinch play on the monthly chart. So we have that developing. We have good ADX. The ADX was strong to the upside, and it held pretty close to the 25 line during the pullback. So those are really big positives on that from that standpoint. Now, if I go and start looking at the weekly chart, hold on just a sec. Let me get into this. So the weekly chart is showing this breakout move and then the pullback. So this is the pullback on the monthly, and it comes down and it does an ABC decline. And if you're watching here, you can see a few things develop. Number one, this basically makes a minor new low here. And then if you look at the MACD histogram, you can see that we have a higher bottom developing there. So it's not an official divergence, but it has that sort of divergent look to it. And to me, that's enough when you're in the area of a breakout and you're showing really good strength on the higher time frame and really good strength on the last move on the weekly here, then I think you can look at this divergence as a helpful tool. And as I go through and look at this, I would say that for me, the first entry point would have probably been on this big green bar right there. So if I'm looking at that, I'm pretty convinced that I like this big green bar here. It's crossing back above the 40. It follows divergence. Now, there's a couple of things that I think you might recognize. Number one is that there was overrun in the MACD lines themselves, meaning they came down and they overran the 0 line. And when that happens, I'm usually inclined to want to wait for the next pullback after that. But because there was some histogram divergence, and based on how strong the trend was based on the fact that we were breaking the downtrend line. I mean, there was enough positives here. And because the size of this bar was so big, crossing back above the 40, I think you could use that as a signal. So that's kind of one area that I'd be watching. The second one would be coming up here, which is this pullback into a pinch play on the weekly. And then if we look again, we had another pinch play develop here. So we had the move to the upside crossing the 40 on a big green bar that follows histogram divergence and a break of the downtrend line. That's one trigger. So you might have felt like, and let's just make this pretty clear, because that first signal happened via a gap. Okay, so if that happens on a gap and you're feeling like, I really missed the signal because I really don't get the true entry point, then what I would do is wait for the next pullback. And it happened to be a zero line reversal on the daily chart. So if you look at where this was a pinch play on the first pullback to the 18 on the weekly chart, ended up being a pinch play, a zero line reversal on this time frame. So that's kind of how I would look at that. And then we had another signal on a pinch play on the weekly chart where the ADX is now crossing above 25 and showing some strength. And this was another zero line reversal. So again, on these, when you're getting that crossover, I think you can play that trigger as it's crossing over. That would have been crossing through the 100 area. So, that's another signal. Then we can go and realize that on the daily chart, we actually got another signal that took place, and this would have been using the hourly chart. So notice what happened here. We went in, we crossed over, and then we actually came back down and formed another pinch here, and then coming back up through the 40 here, probably on like the 22nd, would have been another signal to get in, but this time off the hourly chart, using the daily as the higher time frame. So we start out with the monthly, and we get three different opportunities using the weekly and the daily, really, because the triggers took place on the daily chart. So depending on how you do want to do it, you could have done them as monthly, weekly trades and just triggered off the weekly coming up through off the pinch play. Or you could have used the pinch play pullbacks on the weekly chart and used the zero line reversals as triggers on the lower time frames. And by doing that, you could reduce your risk because you're going to use the daily chart to manage the trade. If you do it that way. If you do them off the weekly chart, then you manage the position off the weekly chart. I hope I've explained this enough over the course of the past year or two that you guys have an understanding of how to work out these time frames and how to manage the positions. Because if I'm trading off the monthly down to the weekly, then I'm going to manage it off the weekly chart. If I use these weekly pullbacks and I trade and trigger off the daily, then I'm going to use the daily to manage the positions. Now, on this last trade, because it's a pullback on the daily chart that doesn't even show up on the weekly, then I'm going to go down to the hourly time frame, and typically I'm going to manage it off the hourly time frame. And if I do these trades around earnings time, I'll usually do them with options. I don't really like, and I'll take what I was going to risk in the stock and then put that into the options. So that's how I would go about kind of managing these positions this way. So you want to think about it this way. Look at where the trade is occurring. And for me, the trade is where a stock has the sideways line, makes a move to the upside, breaks out and pulls back. That's the time frame I'm trading. So where is that occurring? Well, the first one is on the monthly, this first pullback here. And then after that, you had a move to the upside and then a pullback, and then you had two pullbacks to the 18 MA on the weekly chart. So those two trades I would view as weekly and daily. Then finally, we had the pullback on the daily chart. Doesn't even show up on the weekly, and it certainly doesn't show up on the monthly chart. And so that I'm looking at as a daily trade with an hourly trigger. So once you start to understand this, and I think the key thing to realize is I'm looking for a pullback to the 18. In most cases, that's essentially my trigger. So let me take all these lines off. So whatever time frame I have a pullback on the 18, If I'm playing this pullback trade and I'm doing it in 2 time frames, this is really what I'm looking for. I'm saying I've got a stock that where the 18 might have been falling and now you're pulling back for the first time, or I'm trending to the upside and I'm getting a pullback to it for the first time. So either one of those would tell me that that's the time frame I'm trading, and then I go to the lower time frame to look for a trigger. So hopefully this does make sense, but the key point I want to make today is even if you miss that first signal, you didn't miss a whole lot. So if the trigger were up around 85, 86, 87, you could have gotten another signal somewhere low 90s or something like that a few months later, and then you could have gotten another trigger right around 100 probably when it was all said and done, another few months after that. And then about a month later, you got another signal off a smaller time frame. Now, there's nothing wrong with taking this trigger off the hourly and using it as a way to get in on the weekly. And then if you want to do that, you can use a wider stop. You just have to use a smaller position size. If you trade off the hourly for your timing, you can use a wider stop using the weekly at that point and say, I got in at 100 or whatever it is, 100 and change. It ends up being, in this instance, let's just say the trigger, you would have been in around 105, 106, 107. Then you give it down to this last swing low, and you're going to use this. You're going to use that as your stop and to figure out your position size from that standpoint. So there's nothing wrong with doing that. You just have to take a smaller position. So I just wanted to make sure you understood that there are typically 3. I see normally at least 2 to 3 opportunities in every trade. So don't give up on them if you don't get in on the first chance. All right. Post any questions or comments. We'll see you next time.